Good afternoon, and welcome to the end of week market review for Friday, May 31st, 2013. You're going to notice that both our US and Canadian markets are declining bullish. Our agenda is to start things off by taking a look at the market news and get an idea of what's been going on and how it's been affecting the markets. One of the things that we'll be looking for are the economic reports. Once we've done that, we'll go ahead and take a look at both the S&P 500 as well as the Toronto Stock Exchange. While we're reviewing these charts, we'll be looking at daily charts and weekly charts, both in short term and long term. Once we're done with that, we'll go ahead and take a look at the volatility indicator. So we can see that the markets are down for the week, but they did end up continuing their gains for the month. Right now, the Dow Jones is down 1.23% from last week's close, with the S&P 500 down 1.14% from last week's close. Moving on to our commodities, we can see that we have oil, silver, both down. Oil is down 2.41%. This puts it to $91.61 per barrel. Silver is down 4.88% from last week's close. This puts it to $22.20 per ounce. We do have gold up 0.69%. This puts it to $1,395 per ounce. Finally, our US Canadian pair is up 0.56%. This puts it to 1.0368 pips. So we can see that the markets really did end up having a fair decline. And as usual, when the markets are starting to look a little bit sour, a little bit weak, we end up seeing commodities such as gold rising. Now, one of the main contributions to our declines is the fact that our jobless reports ended up being worse than expected. We had 354,000 reports as opposed to the 345 that we expected. By having more claims than expected, it definitely was a feeding ground for some concern. This was after the S&P 500 and Dow Jones have both been in some higher highs and have really been looking for a pullback because they're so overbought. So with that said, here we are, we're looking at the S&P 500 on the daily chart. You're going to notice that each of these candles represents one day. The big thing to note here is that we have been finding some support at this trend line right here for the last 4 or 5 days. But it wasn't until today that we ended up having that significant decline and finally breaking down below support levels. Not only did we break below that trend line, but we also broke down below the 22 EMA. Because we're now below some key support levels and the fact that our MACD is declining bullish and falling so sharply, we could expect further declines, potentially down to the 50 EMA. Here we're looking at the S&P 500 on the weekly chart. That means that each of these candles will represent 1 week. While looking at this, you can see that this week's candle broke down below key support levels. This means that we've broken down below support on the daily chart and the weekly charts. Although we could end up seeing declines down to 1,550, we'd have about 120 point decline in order to get there. That would be quite the pullback. We're obviously going to hope that that doesn't happen, but if it does happen, it just means that we've got more room for growth the next time around. We'll have clear cycle highs, clear resistance levels that we can aim for profits. But also, if you take a look at what's been going on throughout the last year or even longer, we can see that pullbacks that we have do last 4, 5, 6, 7 weeks. but that doesn't mean that it's the end of the rally. It just means that they recoup and work themselves up again. This becomes very clear when you look at an even larger chart. This goes back to about 2002. Here you can see that we've had a huge run, and when things were really good here, even the beginning signs after that recovery from 2008, we can see that the declines that we have do last about a month, maybe even 2 months. All right, here we have the Toronto Stock Exchange. We've jumped back to daily charts, and we can see that today we did end up breaking down below a key support level. It's also important to note that the MACD is declining bullish, and also we have the black line breaking down below the blue line. So the TSX is starting to show a fair amount of weakness as well. Here we can see the TSX. We can see that it's on the weekly chart. We can see that the decline for the week is still a little bit above some support levels, which are just above 12,500. So we have about 150 points that we can see on our initial decline. Whether or not that's going to happen is obviously going to depend on the market conditions, but it definitely is a real possibility considering we started to see that breakout below support on the daily chart. Here we are looking at the TSX right back to 2002, and it really just gives us a perspective of where things are. We can see that we've had some good rises over the last several months, but the resistance seems to be pretty consistent with some difficulties breaking up above 13,000. Because we have that significant resistance and now starting to see some overall weakness in the markets, it's very possible that we will not see the TSX hitting 13,000 anytime soon. But obviously, stranger things have happened. All it takes is a little bit of good news these days to help the markets rise. All right, now our volatility indicator. This indicator is currently at 15.77. We know that throughout 2013, its typical trading range has been between 12 and 14. So it definitely is higher than it typically is, although it's not nearly as high as it has been on this chart. What we can see here is that there's been 3 key times where it's broken up above the 200 EMA. All 3 times it worked itself right back down again. So we're not too concerned with the fact that the volatility indicator is as high as it is. Obviously it could go higher, but if it follows suit, it is going to work itself back into a normal trading range. If it doesn't, we need to make sure that we're starting to exercise caution and being very careful while we're trading. Obviously, if the indicator works itself up into the 30s, that's when we would be reaching the actual defined volatility that we would be looking out for as per why the volatility indicator was designed. So we do have quite a bit of rising to go before we have to be concerned with the overall markets. So on that note, if you have any further questions, feel free to either contact us via email or our phone number, both of which are listed on the screen. Make sure that whenever you're trading, you're always falling back to your predetermined trading disciplines, never deviating away from what you've been taught. This has been the end of week market review for Friday, May 31st, 2013. Ciao for now.